Hello everyone, this is Mark Kinney, Chief Investment Officer of Newport Private Wealth with this third quarter update. One of the challenges of reporting to you quarterly is that if we are doing our job properly, there shouldn't be a lot new to report from quarter to quarter. That's because we're not traders. We set an investment strategy and make portfolio decisions to outperform over a 3 to 5 year market cycle, and we work to be measured and accountable to that time frame. Within any 3 to 5 year period, there are typical peaks and valleys, periods of irrational exuberance or extreme pessimism. And what we are currently seeing are some serious peaks or near peak valuations. What is rare, though, is that both stock and bond markets are reaching new heights at the same time. This correlation has confounded investors the world over with conflicting messages about what it means. Allow me to shed some light on what is happening and the implications for investors' risk tolerance and return expectations. Over the past year, the global economy has been growing, but the rate of growth has slowed, raising concerns about whether the economy will slide into recession. This has caused a flight to safety, primarily into bonds, a traditional safe haven. As a result, bond prices have soared and yields, as you've probably read, have fallen to the point where approximately 17 trillion of global bonds now trade with a negative yield. What this means is if you buy one of these bonds and hold it to maturity, your return is guaranteed to be negative. Put another way, you'd be paying someone to borrow money from you. That sounds irrational, but if you're betting that rates are going even lower and that bond prices will rise even further, then you may buy a negative yielding instrument with the intent of not holding it to maturity, but rather selling it as the price appreciates. Much like a surfer rides a wave, but at some point, waves crash onto shore. In Canada, yields are not negative, but they have followed a similar downward trend. Let me work through some math to illustrate what's happened here. In January of this year, the 10-year Government of Canada bond was yielding just under 2%. I don't think many of us would want to depend on that level of income to fund our retirement. By contrast, at Newport, our portfolio of private income alternatives, such as mortgages and real estate, is yielding 5 to 8%, a much better yield for the level of risk. However, since the beginning of the year, yields on that 10-year Canada have been driven down to 1.36%. Because interest rates have fallen so much, the combination of interest and the increase in the value of the bond have produced an 8% return year to date. 8% over 9 months is an annualized return of almost 11%. Now let's remember that historically, bond market returns are inflation plus 2%, so 11% is a wildly exaggerated outcome. Unsustainable and easily and dramatically reversed. This is a clear and present danger to investors who don't understand the level of risk they're taking in bonds. We can't know when or what catalyst will cause the bond bubble to burst, but we can be assured that at some point it will. As we've reported previously, we're underweight bonds as an asset class, and where we do own them, we hold short-term rather than long-term issues. Canso, our specialist bond manager, shares our view and is so convinced of the bond market's irrationality that they have reduced the average duration in their portfolio to 1.1 years. This, I should point out, is the shortest in their 25-year history of managing what is now a $33 billion bond portfolio. It says a lot. By comparison, the duration of the bond market is approximately 8 years. A shorter bond duration provides protection in the event of a reversal, because when interest rates rise, and they will rise, index investors will be giving back their 11% return and then some. Meanwhile, we will continue to collect our conservative but consistent 5 to 8% on our diversified yield portfolio. Now you may be wondering, if global economic growth is slowing and capital is fleeing to safe havens, why are stocks also doing so well? It is a good question, and one that many investors, including our investment committee, spend their days pondering. Even though capital has flowed out of equities and into fixed income at a rate that hasn't been seen since the financial crisis 10 years ago, equities have continued to rally. Part of the explanation is monetary stimulus from central banks. in particular, the U.S. Federal Reserve. Low interest rates can prolong prosperity. Another less obvious explanation is the impact of corporate investments. Through share buybacks, along with merger and acquisition activity, companies have poured 10 times the amount of money into the market than investors have taken out. So support remains for stock markets, even though it is late in the economic cycle. Several clients have asked about a recession. Are we on the brink of one, and how exposed is the portfolio? For the reasons I just explained, we don't think a recession is imminent. Stocks could continue rising on through the U.S. election, especially if the trade disputes are settled and the Fed continues its money-easing policy. I often say to people that we may be in the 7th or 8th inning, but the low interest rate environment could cause the game to go into extra innings. That said, we are now at a lower than typical allocation to public equities, currently about 40% in a balanced portfolio. We have difficulty making the case for more. If our indicators do start to show recessionary signals, we would look to trim our most volatile equity investments. Real estate is about 9% of a balanced portfolio, and we're very comfortable with how those investments would perform in a recession. We're also comfortable with our yield investments and the diversification they provide. We also have approximately 17% in cash that would protect capital and allow us to buy beaten-up assets opportunistically. So there is frankly not much we would change if a recession were looming, which again, we don't think is the case. I know that these are unsettled times, with world events, elections, and conflicts brought to us 24 hours a day on news and social media. And even though you know you shouldn't worry about temporary market fluctuations, they're hard to ignore. I hope that you will take some comfort in knowing that we are doing the worrying for you and that your portfolio is in the hands that will guide it conservatively and always with an eye on protecting capital while generating returns. On behalf of my colleagues, I want to thank you for your continued trust.